A very good afternoon to one and all present here. I am Nischal Abdi, practicing chartered accountant from Bangalore. Will be the moderator for this session today. We have a very beautiful topic on joint development agreements and its income tax implications mainly, which is most sort of the latest trend of CA. Now, I would take my honor to welcome CA Piyush as Chairman of DTC ICI to the program. We take note of him. And I take now next, I would like to introduce our speaker of the day. Her name is Richa Bakiwala, is a ICI member, presently working with Manohar Chowdhury and Associates, a chartered accountant firm with 26 partners and 16 offices all over India. She has more than 10 years experience in direct taxes and international tax, has extensive experience in range of domains of tax related matters like structuring, advisory, assessments, drafting, and litigation. She has also presented on various issues of Income Tax Act, black money law, etc. at various prominent forums and has been contributing articles for various publications. And now I would like to ask our DTC chairman Piyush S. Chachar sir to address the gathering.
Thank you very much, Nischal. Nischal, who is the moderator for the day, the speaker for the day, Richa Bakiwala, and Secretary, Direct Tax Committee, Priya Subramaniam ji, other office team, all the participants, a very good afternoon to you. Welcome back to this weekly seminars, which happens on every Thursday. As you all know, we generally have this seminar at 4 to 6. This time we had to change our timings and we had to start 1 hour early, 3 to 5. I know the participants would generally look on every Thursday for this type of seminars from Direct Tax Committee of ICI for 4 to 6. But then when we have certain parallel seminars which have been conducted by other committees of the Institute of Chartered Accountants of India, we have to adjust those times. And there would be some parallel seminars happening by other committee at 4 to 6. So we thought it appropriate on an institute platform so that largely all the members can benefit and they can try to attend maximum number of webinars which have been organized by various committees. And therefore we preponed it 3 to 5. But generally our timing will continue on every week at 4 to 6. Please keep a note of it. If any changes are there, generally it would be available in the flyer or the mails which have been sent to membership at the large. Rightly said by Nishchal, this is a very important topic, and I know Richa, she has been also working with the Big Four. She has have a good exposure in direct taxation, and she will be able to justify on this topic, which is joint development on real estate. Whenever we talk of taxation on a real estate, I know each and every individual member is most interested into it. Whenever a direct tax committee organizes any conferences, national conferences, there is always a demand that at least one session should be on real estate taxation because it affects everybody. It affects individuals, it affects corporates, it affects firms, it affects builders and developers themselves also, and most largely individually. And therefore the members who are individual practicing chartered accountants who are serving the individual members also are concerned with this, that how would be the capital gains tax, when it will be taxed, how to calculate it. And it is this problem of joint development agreements has been quite foremost. It has been quite in litigations. I know there are certain amendments which have been made, not touching, which Richa would be touching, I'm sure, on 45(5)(a), something which deals with type of JDS. A lot of controversy, we would feel that a lot of controversy has come down by postponement of tax. But I am sure when Richa speaks, you will realize it's not true. Still, there are a lot of things beyond it, which a professional skepticism will be required to understand, to read those JDAs and understand whether actually transfer is taking place and what event transfer really takes place and how 247 is actually triggered. So I'm sure it would be a very wonderful session, Richa. So all the best to you. Please be attentive on that. Before I actually go back to the speaker, being a chairman of Direct Tax Committee, I thought I'll just brief upon generally, which I do, but the participants keeps on changing. So it may sound repetitive for some of them who generally attends this on every Thursday, but there are always a new members who join because of the specific topics. So as accordingly, this year Direct Tax Committee has set up their plan. What would be the plan of activities? Apart from this weekly webinars, which every alternate Thursday, we do one for direct taxes, one for international taxation, two important things which we have taken into our stride is one is coming up with a guidance note on the audit report of 10B and 10BB. Last year we came with an implementation guide already, and as we all know that guidance note is an at higher pedestal. When I talk about higher pedestal means whatever authority is attached to the publications issued by institute, guidance notice that higher pedestal when compared to the implementation guide. It is sort of a mandatory publication whereby the members are expected to follow it, and if they are not following it, they need to document as to why the procedure audit procedure given in the guidance note has not been followed, so that they can answer the questions if any raised by the regulatory bodies while discharging their assurance functions. So we will be converting this into guidance note. We target somewhere in June, we will be able to come with a guidance note, which will help members at the large. If anybody has a suggestions, please do write to it. You already have implementation guide, which is available with you. It's available online website also, which you can download. And if you have any further suggestions or amendments to be made in that, which we can incorporate in our guidance note, I'm sure it will help with that. We have often seen that a lot of members do say that there is certain changes required in implementation guide, certain areas have not been addressed. When we meet the members in conferences or in the physical networking events, they do speak about it, but we have not been receiving emails or actual suggestions which they want to bring it before the direct tax committee, or if they want to bring it in such publications. My earnest request to you would be, please write to us at dtc@ici.in. As a member of this institute, whatever you would be writing, please, I can assure you, we'll consider that and we'll try to incorporate that in the implementation guide and guidance note if found necessary by the committee of direct tax committee. It's very important, and this will help you because your suggestions are very important. It will help the general members while discharging their audit functions. Similar to the audit report of 10B and 10BB guidance note, we are also coming with an implementation guide on the revisions which have been made in Form 3CD. Already groups have been formed last week itself, and we are having a preliminary meeting tomorrow. And in the preliminary meeting, we'll describe the way forward, and we'll try to come as soon as possible the revisions. I know the most important aspect which all the members are looking is to the clarification which will be coming through this implementation guide on 43 capital B. Yes, there would be some clarification coming, there would be some guidance coming to an auditors. Obviously, institute is concerned of its auditors. It is concerned with the audit function which is discharged by members, not with the legal interpretations involved or the disputes may arise in the section 43B interpretation. So my request would be, when this implementation guide comes, please do look into it. Please follow the same while you are discharging or you are reporting in your Form 3CD as far as section 43 capital B is concerned, because that would be the new one. Otherwise, your guidance note continues as it is. Up till now, we are not thinking of, or we have not thought of revising whole guidance note per se. Very soon, apart from this, we would be also presenting a pre-budget memorandum in this month itself to the CBDT chairman and the policy team. If anybody has again suggestions, I've been keep on telling on this every weekly webinars. If you have any suggestions on that, any suggestions, please do forward to our direct tax committee. We'll try to incorporate that after the due deliberations. My only request is, whenever you are sending us suggestions, please give a justification for it. So for an example, I want some amendment in 43 capital B, which is expected. I want to suggest something. Please tell me, what is this provision of section 43B? What is amendment sought? And what is the justification and rationale behind it? Please understand that whatever suggestions you are sending has been discussed by the committee of a direct tax committee. And without justification and rationale, nobody would be able to appreciate why you want this amendment. Foremost, and it's not only direct tax committee of ICI, this is again represented to tax policy matters who have applied a lot of their mind when they came with these provisions, for an example. So proper justification and rationale is must whenever you are giving. It's like as if you are arguing your case before your commissioner or before your tribunal. So when you are involved in tax litigations, it is not, you have to give a rationale and justification for your position which you have taken while filing the return of income. So please keep this in mind. So these are 2 or 3 important activities in next 2 or 3 months which will be taken up. If you have any further suggestions, please do write to me. Thank you very much once again for joining in large numbers. Just for the information of speakers, before we started this webinar, we had already 1200 plus registrations, and I'm sure over a period in 2 hours, it will cross further. It will go beyond 1500s, which is a general trend. And considering the importance of this topic, which will be addressed by Richa and moderated by Nishal, I'm sure you will be having a lot of questions on it, and I'm sure you will be trying to answer. As a regular feature, we generally, whenever such webinars happen, and because it is happening under the Direct Tax Committee, a member may feel it's an authoritative. Obviously, whatever speakers speak, it's her opinion. We institute generally do not go with the opinion of the speakers. I just thought I will just make that disclaimer to it before it goes. So it's a speaker's opinion. It's not an opinion which will be given, or the answers which will be given represents the answers or the opinions of the Institute of Chartered Accountants of India. So thank you very much once again. Thank you very much to Richa and Nishchal. Thank you very much for the team. Have a very happy learning. Thank you very much. Over to you, Nishchal.
Thank you very much, sir. It was very much warm, welcoming note getting from your end. Very happy to listen, and this is a very head start for us to for this event. So now we are all interested and excited to learn about this topic because it's an ocean by itself, and enough number of doubts, clarifications are required. Questions are already popping up extremely. So no more time to waste. Over to CA Richam over this speaker.
Very good afternoon to all of you. And first of all, I would like to convey my thanks to Mr. Nischal and Mr. Piyush for a wonderful introduction. Having said so, also, I would like to thank Direct Tax Committee for giving me this wonderful opportunity to speak on a very important topic: joint development agreements, income tax implications on the same. And having said that, we all know, how important the topic is, how the real estate industry is growing in the past few years. This topic all the more becomes very important for us as the professionals. And that is why, I would like to take this up now and on a very important topic. So I will just share my screen with you.
It's visible.
Yeah, it's visible. Thank you. So as we spoke about why real estate industry, first of all, is just growing magnificently and exponentially over the past few years. And that is why the real estate transactions like joint development agreements are becoming more and more popular over the years. So real estate industries, there are certain statistics which are there on my screen, which I would like to tell you. And these statistics will tell you that how real estate industry is growing and why, these transactions like joint development agreement are exponentially important for us to understand that what are the intricacies of these transactions, how we should read these transactions, how we should interpret these transactions so as to analyze the tax implications. As we have seen in past 2-3 years, the real estate industry has taken a stride, and the main factors that are contributing to that could be urbanization, largely urbanization, infrastructure development, etc., which is contributing to the growth of the real estate industry. I mean, the statistic in front of me and which front of everyone on the screen are remarkable. Real estate sector is expected to touch a $1 trillion market size by 2030, accounting for 18 to 20% of the India's GDP from an existing share of 7.3%. Another remarkable thing for the real estate industry is that real estate sector is the second highest employment generator after the agricultural sector. And real estate industry also has an impetus to investments. Indian real estate sector witnessed a strong private equity investments of $1.2 billion in quarter two of 2023, demonstrating investors' confidence in the market. This was 63%. I mean, it's a significant number, 63% higher than the previous quarter and 60% higher than the same time last year. And we have all seen that after COVID, how the real estate market has taken a stride. and the residential, not only the residential segment, but also the commercial real estate sector has grown exponentially in the last few years. I mean, what the data suggests is the top 8 cities of India garnered the sales of 3,08,940 units, reaching a 9-year high. India's real estate sector saw a 1,700 acres of land deals in top 8 cities in the first 9 months of FY22. So these are the figures of financial year 22, which are remarkable. I mean, 2023 figures is not there in the public domain, so you can imagine that how the real estate sector is growing in the last few years, and how they have taken a stride in the last few years. In the upcoming year 2024, it is expected that the real estate market it will reach a projected value of US dollar 40.94 trillion by 2024, which is commendable, and which, if everything goes fine, I mean, it will definitely serve as a growth engine in the real estate industry. Government is also, pushing up the real estate industry. Government has allowed FDI up to 100% in the township and the settlement projects. And there are investments in. Also, they are providing impetus to investments, and we can say the Blackstone, a leading global alternate investment firm, has already invested in real estate, Indian real estate, up to US dollars 50 billion, and is expected to further increase by US dollar 20 billion by 2030. As we all know, how the housing market is increasing in the last few years, the Indian residential real estate sector experienced remarkable growth in 2023, reaching a pinnacle not seen in the last 15 years. So with these impressive data and statistics, we all know that the house real estate market is booming in the last few couple of years. Given all of this, it is all the more has attracted not only the builders, developers, the home buyers, to get into the deals, to get into the real estate deals like the joint development agreement. It is also very important for us, for the profession, to understand, because this is how the economy is growing vis-a-vis the real estate market is concerned. But everything comes with a challenge. Now, what is a major challenge do you see in the real estate industry? The major challenge in the real estate industry is the soaring land prices. The land prices in the last year have increased, and they are skyrocketing. Now, what is the grappling effect of the soaring land prices? The grappling effect of the soaring land prices is the developers, would not like to invest in the high, making a high investment in the land, because they will have to forego on their working capitals, etc. At the same thing, the cost of construction for the buyers would also increase. Therefore, I mean, there will not be a perfect balance, I mean, for them to navigate in the real estate industry. So the major challenge that the real estate industry faces is the land prices, and how they optimize this. So there are a couple of options available for the landowners to monetize the land. The first and foremost, the plain simple vanilla option is the outright sale. They make an outright sale of the property is, the complete transfer of right is there from the seller to the buyer. In this case, I mean, as you can see on your screen, it is a matrix, risk return matrix, which shows that the various options and how landowners can monetize the land. And one of the options is the outright sale. Here, the risk and returns both are low because of the low valuation premium, which would landowner will get in this option. The other options available are the joint ventures. Joint venture generally is characterized by the shared ownership between the two parties. Here, the risk would be little higher, but the returns would be medium. Generally, this is the trend that has been seen. The other options available is the development management agreement. Now, what is development management agreement? Development management agreement, there are two parties who get into a contract with each other, and they enter into a contract, and whoever assumes a higher risk will get the higher return in that particular contract. So there's a development management contract. Herein, the risk and reward both are higher. So the most optimum arrangement that is generally being seen is the joint development agreement. What happens in a joint development agreement is the one party contributes the land and other party agrees to develop that particular land. Here the landowner can monetize the more rewards because they sort of become a equity partner in the arrangement. So therefore the most optimum the solution which generally how it is seen is the joint development agreement, and that is why over the years it is gaining importance. The joint It is gaining importance, and therefore it is very important for us to understand the nuances and intricacies of the joint development agreement. Moving ahead, as we have discussed about the importance of the JDA and why it is important. So we have discussed that why the what is the challenges which the developers or the buyers face because of the soaring land prices, and JDA is an optimum option for the landowners basically to catch the opportunity of the increased land prices or of the increased land prices. So landowners also want to encash the best opportunity. Landowners lack the technical and financial ability to commence and complete the project. And the skyrocketing land prices is a major component of the project cost. Real estate developers are also not interested in making the investment in land. So all of these taken together, all of these taken factors together makes the joint development agreement even the more, why it is more important. Now, before I move ahead, we should all understand about the mechanics of the joint development agreement. Very elementary and very fundamentally how the joint development agreement works. This is very important for us to understand so that it will help us to actually analyze that what could be the implications of the joint development agreement. Fundamentally under the joint development agreement there are two parties. One is a developer and one is a landowner, and the purpose for that is to construct or develop a project, and generally the consideration is shared between the landowner and the developer basis either a fixed consideration or percentage of the sale of the units, or maybe some lump sum consideration. So these are the mechanics that they devise between themselves about the commercials in the joint development agreements. Now, joint development agreement, the mechanics. What generally happens in how the mechanics of joint development agreement operates? What happens under this kind of the agreements is the landowner and the developer enters into an agreement. Through that agreement, the landowner transfers the development rights to the developer to construct, to build, to develop that particular land. And for that, the landowner also issues a general power of attorney to the developer. It is very important for the developer. It is very important aspect because through a general power of attorney, the developer has gotten the rights to sometimes to represent before the authorities and seek the requisite approvals. Then, as I said earlier, then they enter into a compensation. Typically, landowner is compensated in one of the ways, either a fixed consideration, fixed built-up area, or percentage of total realization. So this is how the mechanics of the joint development agreement works. Now, key elements of JDA. It is very important for us as a professional to understand the key elements of the joint development agreement. So what happens is whenever we get a client, or whenever we get a joint development agreement, and we get a query about what are the implications of the joint development agreement. First of all, the genesis of the entire things lies in the agreement itself. There are certain clauses in the agreement, certain important clauses, which I will just tell you briefly, that we need to really understand properly. So to understand what could be the implications of those uh, implications of those arrangement in the joint development agreement. So first of all, one is the resource and the cost. Typically in the joint development agreement, the two parties, landowner and a developer, they pool in the resources. So they enter into a collaboration agreement by contributing their respective resources. So, the landowner typically brings in the land, the developer brings typically the expertise it has and the knowledge it has. They collaborate together and they collaborate their resources. And we have to need to really understand this kind of the arrangement, that what resources, what each party is bringing. We have to meticulously evaluate that kind of the clauses. Then, very important is about the cost. Now, there is a cost which is incurred on obtaining various approvals from the regulatory authorities. There could be a cost like payment to external and internal development charges. There could be the major cost is the construction cost, marketing cost, etc. All these costs are typically incurred by the developer. So we need to see that, what is this arrangement, what is that arrangement is there between the developer and the landowner regarding how they will share the cost or who will bond the cost. So this is very important to understand whether, what are the commercial aspects between the two parties. Now, another thing about that is the title. Generally, the title there, through the joint development agreement, there is no sale of land. The title of land is generally not transferred in the favor of the developer through the joint development agreement. The another aspect is the power of attorney. Now, power of attorney, why it is very important. Typically it is, it is kind of a supplementary agreement along with the joint development agreement. And through power of attorney, landowner gives the rights, the rights to the developer to enter the premises, and develop the building or for the construction. Also, it is very important. Why it is very important that the developer takes finance, or takes finance on the for the project. And sometimes, the developer also give rights to create a charge on that asset, on the land. So all these, what kind of the rights, of the rights are being given by the developer, given by the landowner to the developer, are very important to actually understand. So what kind of the authorities are being given by the landowner to the developer is very essential to understand. Development rights. Typically, through the joint development agreements, the developer grants the development rights to develop the project as a residential or a commercial unit, as the case may be, to prepare the building plan over a plan map sanctioned by the regulatory authorities, to carry out the constructions, to develop the utilities, and for the maintenance system. So typically, these are the development rights that are granted by the landowner to the developer. And sometimes, or I should say usually, the marketing rights are also given by the developer, are also given by the landowner to the developer. Marketing rights to say, once the project is completed, the developer gets a right to market that project and receive the sale consideration from the customers. So these are typically, these are kind of the arrangements that we need to very carefully analyze of the each joint development agreement. Then, of course, another one is the sharing of revenue. So how the revenue is shared between the landowner and the developer is also very important. For example, in what stages the consideration will be discharged by the developer to the landowner, what kind of the security deposits, whether refundable, non-refundable, advance money, what kind of the such deposits will be given by the developer to the landowner, whether there will be a revenue sharing model, or it will be just a it will be shared in the land or the building, or there could be a lump sum amount of the consideration. So there are various mechanics which operates for the sharing of the revenue between the two parties. One has to carefully analyze these commercial arrangement that is probably going to would be entered between the two parties. Termination of agreement. As we all know, that there are several of cases, and I'm sure everybody must have come across with such kind of the cases, that there is a fallout in the joint development agreement. Generally, the joint development agreement are sometimes subject to the granting of the necessary permission by the regulatory authorities. Sometimes you do not get the requisite permissions, and that is why that there is a fallout in the joint development agreement altogether. Sometimes there are the breach of contract, or a breach of the performance by either of the two parties, and therefore there is a the fallout of the joint development agreement. So therefore, it is very important for us to know that to protect the interest of both the parties, what is the termination, what are the clauses, what is the arrangement in case that there is a termination of the agreement, what are the roles, responsibilities, and the obligation of each party in case of the termination of the agreement. This is a very important aspect to really understand, especially given that the joint development agreement are subject to various contingent events. So that is why this clause becomes all the more very important for to understand. Largely, I think we have already discussed what are the benefits of the joint development agreements. The benefits of the joint development agreement, it is, you may say, it is an optimum solution and a win-win solution for both the parties, that is the landowner and the developer. Now, what happens is, so for the developer saves himself from making a huge investment for purchasing the land, and the stamp duty is also avoided for the transfer of land. It is, as we have already discussed in the risk return matrix, it is a very lucrative offer or consideration for the landlord. And the last one is, because the developer has the requisite expertise, the developer has the requisite skill, there is a speedy construction of the property by the developer. So these are largely the key benefits of the joint development agreement. So what we have seen so far is, how the joint development agreement is an optimum solution for the parties in the agreement, for example, the developer, the landowner, vis-a-vis the risk return matrix. And what are the key benefits? And it is somehow the win-win situation for both the landowner, because they can catch the opportunity of the good valuations, and for the developer also, because they don't have to plug in their huge cost or huge investments in the land. So this is kind of becomes a most optimum solution for both the parties. Now coming to an important aspect, that is statutory provisions of the joint development agreement. This is the legislative encompass, which encompasses what are the sections under the Income Tax Act which affect the taxability of the joint development agreement. Now, one is, we need to see whether that particular land or building in question is a capital asset or not. So to understand whether that's a capital asset or not, we have to refer to section 2, the definition section 2, subsection 14, which defines capital asset. And it says that capital assets means property of any kind held by the assessee, but does not include stock in trade. So we need to see first whether the questioned land or building is a capital asset or not. And then we need to see, whether the questioned asset has been transferred or not. For understanding when the implications of the transfer triggers, when the transfer triggers in such kind of the arrangement, we need to refer the definition of the transfer as given in section 2, subsection 47. There are two clauses which are very important, and which are actually triggered in case of the joint development agreements are clause 5 and clause 6. Clause 5 says any transaction involving allowing of the possession of any immovable property to be taken or retained in part performance of a contract of the nature referred in 53A of Transfer of Property Act, and any transaction which has the effect of transferring or enabling the enjoyment of any immovable property. So basically, these two subclauses, they refer that one subclause refer that if there is a part performance of a contract in terms of section 53 of Transfer of Property Act, then transfer would trigger. Or if any transaction in which has the effect of transferring or enabling the enjoyment, then the transfer would trigger. So there's a capital asset, and if the transfer triggers, there obviously arises the capital gain implications. Now, capital gain implication, the charging section is 45 subsection 1, which says that profit and gains arising on the transfer of a capital asset shall be deemed to be in the previous year in which transfer took place. So this is the charging section which says once capital asset is transferred, the year in which it is transferred is when the capital gains would arise. And now, as we discussed earlier in our presentation also, that there were a lot of litigations with respect to the joint development agreements, and then the Finance Act 2017 has introduced a new section 45(5)(a), which specifically deals about the joint development agreement. So this we will discuss in our next few slides. So this is how these are the main important sections which affects the taxation of the joint development agreement. Now, the moot questions which arises is when does the transfer takes place? And this has been the moot questions before the judiciary, and judiciary have been taking a different view. The AOs, the assessing officers, have been taking the different views. The assessee have been taking a different views that when does the transfer takes place in the JDA, and this aspect has been historically happening before 45(5)(a) came into the picture. And there were cases to say that when the possession of the land to develop, when the possession of the land to develop is granted to the developer, is the time when the transfer take place. However, there were certain views which says that the possession is granted on the completion of the project is the time when the transfer take place. And there were certain school of thought which says that on receiving of the sale consideration by the landowner is the event when the transfer takes place. So, I mean, there has always been a debate that when does the transfer takes place in these kinds of the typical joint development agreements. Now, it is when we talk about joint development agreement, and when we talk about the history of the joint development agreement, it is very important for us to understand about the judicial history of the joint development agreement. One of the earliest decision in this matter was of the Bombay High Court in the case of Chaturbhuj Dwarkadas Kapadia. So I will just try to briefly explain that what has happened in this case. In this case, the sequence of events can be encompassed in this period of 6 years. So what happened in the year 1? In the year 1, the assessee landowner entered into the registered agreement with the developer to develop the land, and in that agreement there was a clause that when the developer will obtain all the necessary permission is the time when the landowner will transfer will issue the irrevocable power of attorney to the developer. Now, in the year 6, now this happened in year 1. In the year 6 is the time when the land when the developer was able to obtain the necessary permission from the requisite regulatory authority. Meantime, in the year 3 is the time when the landowner had received a substantial amount of consideration from the developer. Now, assessee said that the transfer has triggered in the year 3 when it has issued the irrevocable power of attorney to the developer. Now, assessing officer said that no, the transfer has triggered in the year 3 when the substantial amount of consideration was given to the by the developer to the landowner. So this matter went up to the Bombay High Court, and the Bombay High Court said that neither the transfer took place in the year 3 nor in year 6. The transfer took place in the year 1 when the agreement was entered between the landowner and a developer, and the landowner had given a right to the developer to enter into the premises and construct the land and take the necessary approval or whatever it is. So they said that no, the transfer triggers at the point when when the landowner has given the power of attorney to the developer in the year 1 itself. So that they said that even in case of the limited power of attorney, the transfer has been triggered. Then came the ruling of the advance ruling in case of Jasbir Singh Sakaria, the next event in this. In this, they said that the transfer took place when the landowner shifts the effective control of the land to the developer. Now, when does the effective control shift? Effective control would shift when the irrevocable power of attorney was given by the landowner to the developer. So they said that this is the point when the transfer took place. This was held by the Jasbir Singh Sakaria case of the authority of the advance ruling. So in these two cases, the commonality was that when the agreement takes place and was the time when the transfer triggers. The difference between the two cases is in Chaturbhuj Dwarkadas case, they held that the transfer took place only when the limited power of attorney is given. I mean, when the symbolic possession is given. However, in the Jasbir Singh Sakaria case, they held that the transfer took place when the irrevocable power of attorney is given. That means the actual possession was given to the developer to develop the land. By and large, all the courts were following these two cases, and largely the Chaturbhuj Dwarkadas Kapadia case, and they said that when you enter an agreement, that is the time when the transfer takes place. Now, having said that, turning point came with the case of Punjab and Haryana High Court in the case of C.S. Atwal. In this case, the court, in the light of the amendment which came in Section 53A of Transfer of Property Act and the Registration Act, which mandated that any transfer in a part performance of any immovable property will be mandated only if the agreement is registered. So in light of this amendment, in this case of Punjab and Haryana High Court, they said that if the agreement is registered, that is the time when the transfer takes place. In this particular case, the joint development agreement was not registered, so they said that the transfer has not been taken place. They also happen to read the clauses of the registered irrevocable power of attorney, and they say that even the registered irrevocable power of attorney, the clauses which emanates there, just gives the limited power of attorney to the developer to enter into the land and construct it. They do not give any power to the developer beyond that. So this was a very turning point, and it held that first of all, this agreement is not registered, so it's not a transfer. And even the irrevocable power of attorney stands no good for us to understand when the transfer is triggered, because they said only the limited power has been given to the developer in this case. Now, meanwhile, while this controversy was going on, almost all the high courts, except for the Punjab and Haryana High Court, were following Chaturbhuj Dwarkadas Kapadia case. And thereafter, the C.S. Atwal case was upheld by the Supreme Court in CIT versus Balbir Singh Mani case, where also they held that in order to qualify a transfer of a capital asset under Section 2, subsection 47, clause 5, there must be a contract which can be enforced in law under Section 53 of the Transfer of Property Act. So they said that to enforce a contract, to consider that is a transfer, the transfer should essentially happen through a registered document. So they upheld the C.S. Atwal case, and then uh, the said case was also upheld by Supreme Court in other cases like Chunilal Bhagat, etc. So what we have seen, what we have understood with the judicial history, that when the transfer triggers in the joint development agreement is, even the judiciaries had a different stand, and and therefore what was happening is there were different school of thoughts, different things were happening, that when the transfer would take place in case of the joint development agreement. Largely revenue were following the case of Chaturbush Dwarkadas Kapadia of Bombay High Court, and they held that as soon as the as soon as the agreement is entered into, the transfer would trigger. However, there were certain cases which considered other factors like the registered agreement, as we discussed, or on receiving the sales consideration. They said that when you receive the sales consideration, or substantial sales consideration, is the time when the transfer is triggered. So even the courts were divided, and but generally they were taking the stand of Chaturbush Dwarkadas Kapadia, and they were saying that uh, the transfer in case of joint development agreement would essentially trigger uh, at the moment when agreement is entered into. So with this position, it was causing a lot of hardships to the landowners. Now, what was the challenges for the landowners in this case? So, first of all, if the capital gains arises, if the transfer triggers at the time when the agreement is entered into, and therefore the capital gain arises at the time when agreement is entered into, so what was happening is taxability was arising before the receipt of the consideration by the landowner in the later years. So they were not receiving the consideration, however their taxability arises much before that. So this was one of the biggest challenge in this kind of the position which was taken by the judiciary. The other was revenue used to ascertain the fair market value of the project and the land under Section 50. They were invoking Section 50D and 50C, and they were calculating the fair market. They were calculating the fair value of consideration for the project and the land both. And even when the project was just on the papers, they were just considering that the fair market value of the project, and they were charging capital gain tax. So these were the couple of challenges. Largely, these two challenges were there, which was assessee was facing when the position was taken following the principle of Chaturbush Dwarkadas Kapadia case. Therefore, then the amendment came in through Finance Act 2017, and which introduced the Section 45(5)(a). At very initial discussion, where Mr. Piyush also mentioned that we need to see whether this amendment has given any relief to the taxpayers, or it still holds the interpretational issues that we need to see through the scan of the professionalism, that how we should interpret each and every term of it, and whether it has intended the purpose which the assessees were facing before this section came into place. So, because it has a lot of interpretational issues, I would like to take this up. I would like to, read out the bare provision of Section 45(5)(a) to understand to understand its nuances and intricacies. First of all, this section starts with, notwithstanding anything contained in subsection 1. Subsection 1 means they are referring to section 45 subsection 1. So notwithstanding anything contained in subsection 1, it's a non-obstant clause, where a capital gain arises to an assessee, being an individual or HUF. So the assessees covered are only individual and HUF, from a transfer of a capital asset, being land or building or both. So they are referring to a capital asset being land, building, or both, under a specified agreement. Specified agreement they have defined under the explanation that we will discuss. The capital gains shall be chargeable to income tax as the income of the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. So what they have done is they have not changed the date of the transfer. They have just shifted the chargeability of the capital gains ahead when you have received the completion certificate from the competent authority. And for the purpose of section 48, the stamp duty value on the date of issue of the said certificate of his share, being land or building or a both in the project, as increased by the consideration received in cash, if any, shall be deemed to be the full value of consideration received or accruing as a result of transfer of the capital asset. So what would be the consideration? The consideration will be calculated basis the stamp duty value on the date of issue of such certificate, coupled with whatever the cash consideration has received in the transaction. Provided that the provision of this subsection, now this explicitly excludes, provided that the provision of this subsection shall not apply where assessee transfers his share in the project on or before the date of issue of the said completion certificate. So if the assessee transferred the asset before receiving the certificate of completion, then provision of this section will not be applicable, and the capital gains shall be deemed to be the income of the previous year in which such transfer takes place. So when you make the transfer, it is that year when the capital gains would arise, and the provision of this act, I mean the other provisions of this act, other than the provision of this subsection, shall apply for the purpose of determination of the full value of consideration received or accruing as a result of such transfer. So what we have seen is this is applicable to individual or HUF. Land or building is the asset under a specified agreement. The shift is not the year of transfer. The year of chargeability has been shifted to the year ahead when the completion certificate of the project is received. So this is our nutshell is 45(5)(a). Now, it is also important to know they have provided the explanation to certain expressions I've used in the main section. For the purpose of this subsection, the expression competent authority means the authority empowered to approve the building plan by or under any law for timing in force. So they are referring to the authority which approves building plan. That is the competent authority they envisage under 45(5)(a). Specified agreement. Specified agreement means a registered agreement in which a person owning a land or a building or a both agrees to allow another person to develop a real estate project on such land or building or both in consideration of a share, being land or building or a both in such project, whether with or without the payment of the part consideration in cash. So this is about the specified agreement. Largely the specified agreement should be the registered agreement. And the stamp duty value means the value adopted or assessed or assessable in any of the authority of the government for the purpose of the payment of stamp duty in respect of an immovable property, being land or building or both. So this is about section 45(5)(a). So largely we have seen that this is the effective date is of this. This would be on the JDAs entered after 1st April 2017. It will be applicable on individual HUF. It will be applicable when the nature of the agreement is as per the specified agreement. The nature of the asset should be land or building, or it will be and the capital gains. The chargeability of the capital gains will trigger on the receipt of the completion certificate. And manner of consideration would be, and they have defined how the consideration would be derived. Consideration would be derived as per the stamp duty value on the year in which completion certificate is issued. So this is the nutshell of section 45(5)(a). Computation mechanism. Now it is very important to us to understand about the computation mechanism. Now let us take an example that in the year 2022, a specified agreement has been entered into, and the completion certificate has been received in the year 2024. Now the question arises whether the period of holding will be reckoned only till 2022 or till 2024. to say that whether the period of holding will be reckoned on the date of the transfer in the year 2022, because in that year the specified agreement has been entered into and the transfer takes place, or in the year 24 when the the completion certificate has been received, and completion certificate has been received, and you the capital gains are chargeable to tax. So according to me, the view should be the period of holding should be reckoned only till 2022 when the transfer takes place. There are two school of thoughts in this. One school of thought says that that the period of holding should be restricted to the year of transfer. The other school of thought says the period of holding should be till when you receive the completion certificate. But the better view being, the period of holding should be taken till year of transfer is because this section for section 45(5)(a) is similar to section 45(2), which tells you about the chargeability of capital gains when the capital asset is converted into stock in trade. What was happening there? The fair market value of the capital asset on the date of conversion was taken as the consideration, and indexation was taken. I mean, the period of holding was taken up to that year. Only the chargeability was deferred to the year ahead when when the stock in trade was sold. Only the chargeability was shifted, not the year of transfer was shifted in any circumstances. So deriving the same principles, I feel the better view should be the period of holding should be restricted to the year 2022 in the example which I have quoted, for determining that the year in which the transfer has taken place. Similarly, for the indexation, going by the same logic for the indexation will also be taken off 2022, not of 2024. Going by the same logic that the transfer has taken place in 22, only the chargeability has been shifted to 2024. Full value of consideration. In this case, as we have seen in the base section also, the full value of consideration would be the stamp value on the as of the date of issue of the completion certificate of his share as increased by the consideration received in cash. And as we know that under section 50C, there was a safeguard available to the assessee where they can claim if the fair market value is less than the stamp duty value of that particular land or building, then they can approach to the then the assessing officer may refer the valuation of the capital asset to the valuation officer. However, the similar safeguard has not been provided under section 45(5)(a). Now, very importantly, now we have seen that the computation mechanism of the joint development agreement under section 45(5)(a). Now, what is the fate of the reinvestment exemptions provided under section 54, 54F or 54EC? Whether those exemptions will be applicable to 45(5)(a) or not. When we were reading the bare provision of section 45(5)(a), we saw that section 45(5)(a) start with a non-obstant clause. It states that notwithstanding anything contained in subsection 1, that is section 45 subsection 1. Now, the exemptions under 54, 54F, 54EC, I mean the family of section 54, the exemption is provided through section 45 subsection 1. They say that the any profits and gains arising from the transfer of the capital asset effected in the previous year shall save otherwise provided in section 54, etc., be chargeable to income tax under the head capital gains. So they say that under 45(1) is the section which refers to the family of sections of section 54, and they said that if you are and they refer those section, and if you are able to avail the exemption of that section, that capital gains will be reduced by that amount. So having said that, since 45(5)(a) overrides 45(1) in that respect, and will we not be able to claim the exemption under 54, 54F or 54EC? The answer to that is, it is a very settled principle, and it has been laid by the various courts, that the non-obstant clause overrides only a contrary provision, but it does not affect the or otherwise the clear provision. So it means it will override the non-obstant provision, the non-obstant clause 45(5)(a) will only override 45(1) to the extent of the chargeability of the capital gains. Otherwise, it will not override on the any other provisions, any other the dynamics that have been laid by in 45(1). So having said that, so it will only so it says that the non-obstant clause only overrides the inconsistent clauses or the conflicting provisions. It will not override what it is clear. So given this analogy, we can say that the exemption under 54F and 54EC is available in the cases of 45(5)(a) also. Now, going on to the next dimension of it is whether the reinvestment exemption, whether from when you will reckon the time limit for making an investment under section 54 or 54F. So what does section 54 and 54F contemplates? Whatever the section 54 allows an individual to claim a deduction if he sells a residential house and purchases or constructs another residential house within a specified time frame. Now, what is the specified time frame? The specified time frame is 1 year before or 2 years after the date on which transfer took place in case of purchase, and case of construction 3 years from the date of the transfer. Similar timelines are provided in section 54F also. That is 1 year before or 2 years after the date of purchase, or 3 years in case of the construction after the date of transfer. Now, we have seen that 54F requires acquisition of the house within a specified period from date of transfer. However, section 45(5)(a) does not refer to the date of transfer. It refers that the taxation will arise in the year when certificate of completion is issued by the competent authority. So now how to really balance this out and understand how to calculate the time limit given in section 54 or 54F. Now, one thing which we should understand is, for applicability of section 54 or 54F, there has to be a ascertained crystallized capital gain. This is a precondition of section 54F. So in the year of transfer, like in the previous example, I have taken an example of year 22 and 24. That is, 22 is the year of transfer and 24 is when the completion certificate is received. So in the year of transfer, that is in the year 22, you cannot crystallize the capital gains and you cannot determine the capital gains, because the capital gains under 45(5)(a) is dependent on the stamp duty value on which can be ascertained when the completion certificate is received. So ideally, you can only determine and crystallize the capital gains in the year when the completion certificate is received, that is in the year in which capital gains are chargeable to tax. So we cannot go back in the year 2022 and and calculate a time limit from that time, because it will be difficult to ascertain the extent of the exemption that is to be availed by the assessee. So therefore, in this case, the provision may be construed as equating the date of certificate completion with the date of transfer. There is a similar scenario in case of 54EC. Same thing, in 54EC, what happens is, when you sell the long-term immovable property, land or building, they have the option to avail the capital gain exemption under 54EC by investing in certain bonds. The time limit there is 6 months. So in there, 6 months from the date of transfer. So in this case also, the date of transfer should be equated when you receive the capital completion certificate in the year ahead, and accordingly you have to calculate capital gains and claim the exemption under section 54EC. Now, points to ponder under 45(5)(a). So now we'll take you through what could be the possible interpretational issues, what could be the possible, the stands, and what are the points we should see and ponder vis-a-vis section 45(5)(a). What happens in case transfer before issuing a issuing of certificate of completion? This we had already discussed in the bare provision, that bare provision specifically excludes these kind of the cases. The provisor to section 45(5)(a) explicitly excludes these kind of the cases and says that its application, if the assessee transfer their share in the project before the issuance of the completion certificate, so it will be excluded. And the capital gain shall be deemed to be the income of the previous year in which such transfer takes place. So in the year in which, if before receiving the completion certificate, if the assessee transfer, the year in which the transfer takes place is the year when the capital gains shall be chargeable to tax. And rest other provisions of the act will apply, like section 50C or etc., that will apply as normally. Now, another case that may come up is the completion certificate is received for only part of the project. Now, what happens is, assumingly, if landowner, if the transferor was supposed to receive 25,000 square feet of land, 25,000 square feet of the maybe the completed area, but he have received the part completion certificate of only 10,000 square feet. Now, the question arises that whether the capital gains will be chargeable for the entire 25,000 square feet or for the 10,000 square feet. Why this question is arising is, I will just read the extract of section 45(5)(a), which says that capital gains chargeable to income tax as the income of the previous year in which the certificate of completion for whole or part of the project is issued by the competent authority. So if you receive the completion certificate for the whole or even the part of the project, uh, does that mean that the capital gains will be triggered for the whole of the project, for the whole of the share that was supposed to be received by the landowner? In this case, we may assume a view that we may take a view, and which I think is a very logical view, that capital gains will be triggered if we have received the completion certificate for only a part of the project. The capital gains will be triggered for only that part of the project, that is in our case 10,000 square feet only, because herein, as in section 45(5)(a), the capital gains is linked to the calculation of the capital gains is linked to the stamp duty value of the land. So I mean, you can estimate the sale consideration only for the 10,000 square feet of land, not for the balance 15,000 square feet of land, because the stamp duty value you cannot determine for the rest 15,000 square feet of land, because in the absence of the completion certificate. So in case of the completion certificate for only part of the project, only that the part project shall be liable to capital gains under section 45(5)(a). Another important question: what happens when the landowner receives only cash as a consideration? Whether 45(5)(a) will be applicable? No, the 45(5)(a) will not be applicable when the landowner receives only cash as a consideration. This is why. This is because that 45(5)(a) is only applicable when the assessee, that the landowner, receives land or building or both as their share. I mean, they retain the land or the building, their share in the form of the land and the building, the landowner, then only 45(5)(a) is applicable. When you receive the entire consideration in cash, then 45(5)(a) will not be applicable. I have seen, we have seen certain cases where there was a case when the agreement was entered into. The agreement was entered into like the 95% of the share would be taken in the cash consideration, and 5% of the share in 5% of the share in in the form of a land of building. Whether 45(5)(a) will be applicable? Yes, 45(5)(a) will be applicable, because at least the 5% of the share has been is a subject matter of the joint development agreement. 5% of the share will be received by the landowner. But we also need to see, the risk of GAR cannot be mitigated in such kind of the situation. There could be a possibility. I mean, we need to analyze the arrangement as a whole, and we need to see that what is the intent of the arrangement, etc. But there is a possibility in such kind of the arrangement that assessing officer may invoke GAR. 45(5)(a), does 45(5)(a) applies to revenue sharing agreements, as we discussed. This provision is applicable solely if the assessee has received land or building or both in the project as his share. In the case of revenue sharing agreements, what happens is the landowner and the developer decides the share, the person of the share they will receive on the sale of the units. In that case, the landowner is not retaining any land or a building or the share in the land in the building, and therefore 45(5)(a) typically would not apply to the revenue sharing agreements. Now, this is very interesting. I mean, sometimes what happens is, the landowner gives the land to the developer for obtaining necessary approvals, constructing roads, plotting it, plotting into the sites, building the boundaries, etc., and developing that land itself only. So whether in such kind of the development project, whether 45(5)(a) is applicable. Now, there are two views possible in this case. One is, when we were reading about the where provision, I specifically emphasized that the competent authority, how it has been defined, is empowered to approve the building plan. So they are not, they talk about, this section refers about the building plan, and therefore the completion certificate for the project refers to finishing the building in the project, envisioned building in the project. Consequently, we may say that this 45(5)(a) might not applicable where the project solely involves land development. So this could be the one view, because the competent authority, as has been defined there in section 45(5)(a), specifically tells that once who approves the building plan, they never there's nothing like a land plan or something has been specifically written over there. So one view could be possible that 45(5)(a) will not be applicable. However, there is another view, which is available in this case, where they say that when we are reading 45(5)(a), they say that the capital asset being land or building or both. So independently, if the project is for the development of the land, technically 45(5)(a) should apply in those cases also. I mean, both presently are kind of the academic view, and the better view can only be taken once we review the arrangement or the intent of the parties are reading in such kind of the land development project. But once we should be very much mindful in such kind of the land development project whether 45(5)(a) would be applicable or not. Now, there are sometimes what happens is, the landowner, that is the assessee, is named as a developer in the application and even in the specified agreements. So in that particular case, whether we have to see that 45(5)(a) is applicable or not, in that situation, we need to see what kind of the roles and the responsibilities are undertaken in the specified agreement. If essentially it indicates the developer, the developer is the person who is developing the land, and the landowner name as a developer is only incidental or for protection of certain interests, we may argue that the assessee is only a landowner not developing the land, and therefore 45(5)(a) may be applicable on it. Now comes the TDS implications. So there is section 194 IC, which deducts tax at source on the payment under the specified agreement. So who is liable to pay the tax on such agreement? Any person who is paying a resident a consideration under a joint development agreement needs to deduct TDS under section 194 IC. And there is no threshold limit under this section. And the rate of TDS under this section is 10%. So if you're entering into a specified agreement and there is any consideration that is to be paid, the TDS would be deducted at the rate of 10%. Now, we have seen that there are various conditions attached in section 45(5)(a), and we have discussed that previously. So we need to see that for 194 IC to be applicable, there are certain conditions that we need to see that if they're satisfied or not, which are: transfer of the land or the building or both should be individual or HUF. Transfer of a building or both must be a capital asset. there has to be a specified agreement, and part of the consideration under the specified agreement must be in cash or by issue of check or draft or any other mode. Only in that case 194 IC would trigger. So basically, if 45(5)(a) is applicable to you and you receive a cash consideration, then 194 IC triggers in that particular situations. Now, what about the other situations where 45(5)(a) is not applicable, where we have to deduct TDS? So there is a section 194IA, which in that section you have to deduct TDS in those particular cases. Now, under section 194IA, tax to be deducted at source in case of transfer of certain immovable property, provided a total amount of consideration of 50,000 or more, and it is any person being a transfer responsible for paying to a resident transfer any sum by way of consideration for a transfer of any movable property other than the agricultural land. So TDS will be made at the time of credit or payment, whichever is earlier. So this is the provision that the limit is 50 lakhs and the TDS rate would be 1% of the sale consideration or stamp duty value of such property, whichever is higher. So this is how the TDS will be computed in the other cases, that is under section 194 IA at the rate of 1%. Now, given these two sections, applicability of 45(5)(a) and we should really understand the interplay of the TDS provisions vis-a-vis 45(5)(a), or if the JDA is not falling under 45(5)(a), then what would be their TDS implications? So this table particularly shows that what is the interplay of the TDS provisions. So I have made out five of such situations, and we'll discuss these 5 situations to understand the applicability of the TDS provisions. In a case where the land or a building is transferred, being a capital asset, and capital asset is a resident individual HUF to a resident individual HUF under a specified agreement, then what would be applicable? So in this case, land building is being transferred by a resident individual HUF under a specified agreement. The conditions of 45(5)(a) are satisfied, so 45(5)(a) is applicable, and therefore the TDS would be deducted under 194 IC. Another case where there is a transfer of land or building or both being capital asset by a resident other than the individual is a resident and other than the individual or HUF under the specified agreement. So in this case, what is happening is that the land and building is being transferred by an assessee other than individual HUF under a specified agreement. In this case, 45(5)(a) will not be applicable. 194 IC will not be 194 IAC will not be applicable, therefore, and 194 IA, which is TDS in case of the immovable property, that would be applicable in this case. The another case we can take as a transfer of land or building or both being capital asset by a non-resident under a specified agreement. Now, this being the case, 45(5)(a) is applicable, but the resident being assessee, the TDS would be deducted under section 195. The other case could be that there is a transfer of land or building, which is a stock in trade, by a resident under a specified agreement. In this case, 45(5)(a) will not be applicable because the question asset is a stock in trade and which is not a capital asset. So 45(5)(a) will not be applicable. Therefore, 194 IC will not be applicable. However, 194 IA will be applicable in this case because it is a transfer of the immovable property. Another situation could be there's a transfer of land or building being stock in trade by a resident under a specified agreement. By a non-resident, under a specified agreement. In this case, section 195 will be applicable. And in this case, 45(5)(a) will not be applicable because it talks about the stock in trade. Now, after going through all the provisions of what was there as a judicial history, what happened, what about 45(5)(a), what happens in case of when the land is held as capital asset or a stock in trade, I would like to just give you a brief snapshot of what we have discussed so far. So when the cases of the joint development agreement comes to you, and we have to decide that whether how the capital gains implication or to say the tax implication would arise, we first need to see what is the nature of the asset, whether the nature of the asset is capital gains or stock in trade, because there will be different implications in both the cases. And then again, we have to see what is the type of the SSC. If the type of the SSC is individual and HUF, and if the nature of the asset is capital asset, then 45(5)(a) would be applicable. And if in the case the type of SSC is other than the individual or HUF, then 45(5)(a) will not be applicable. So all these we need to figure out that before analyzing any of the joint development agreement, any tax implication of joint development agreement. Then quickly, I will give a snapshot of what would be the income tax implications if the land is held as held as a capital asset. So if the type of the person is individual or HUF, then 45(5)(a) will be applicable. In the other cases, 45(5)(a) will not be applicable. And the point of taxation, what would be the point of taxation in the first case? The year in which completion certificate is received. And in case the transfer has happened before receiving the completion certificate, in the year in which the transfer has taken place. In other cases, I discussed it is basis the various factors, like largely when the date of agreement, what kind of the nature of rights have been transferred by the landowner to the developer. All of that will be taken into account as we discussed in the earlier slides. So that is how we'll judge the income tax implications in the other cases. What happens if what are the income tax implications in case the land is held as stock in trade? In case of any person, subject to the facts of each case, it is possible to take a view that it would be on accrual concept. It is a business income, and the implications of Section 43(CA) would also arise in this particular case. So this is all about the presentation.
That was a very beautiful presentation and complete go through the joint development agreement and its income tax implications by CA Richard. Thank you very much. Now, with this hot topic in hot summer, we'll go with hotter questions which are getting shooted, and there were a huge number of questions which are going to be asked now. So, shall I go one after the other, Richard?
Yeah, sure.
Okay. So regarding taxability of landowner who has given the land development, and if taxable, what point on which value will be taxed is the first question we got, and it was already addressed, so maybe we can just brush it through.
So basically, this is when in the case of the project of the land, solely on the land development.
Correct.
Right.
Land
So
development.
yeah. So there are two views, as I previously explained, that there are two views. Whether first of all, whether 45(5)(a) would be applicable or not applicable. In case 45(5)(a) would be applicable, then when you received a certificate, when you receive a certificate equivalent to the completion certificate as contemplated for the buildings over there, that is the time you determine the stamp duty value and compute the capital gains. In a case where where we take a view that 45(5)(a) is not applicable, then we have to determine maybe the fair market value of that land to understand the capital gain implication. 50C, we may trigger 50C in that particular case.
Okay. So one more thing, Mr. Ramesh is interested to learn what are the major problems faced in JDS, especially in perspective of taxation, more critically seen through.
So the most important and the significant aspects that we need to see about the joint development agreement, critically we need to see each and every arrangement that has been taken care that has been executed between the landowner and the developer. So to say, the first instance is what kind of the rights are being transferred by the landowner to the developer, and to the what extent the rights have been transferred. So as I have taken you through the judicial journey in my slides, there are cases to say that, and generally we have taken a view when an irrevocable power of attorney is given by a landowner to the developer is the time when the capital gain arises. So we have to meticulously and very carefully analyze the land development agreements, and while drafting it also we need to take some of these points in mind.
Okay, we'll go to the next one. Is rent received by the tenant during the time of construction go taxable?
Rent received by the tenant.
Tenant.
So basically, you are saying in case of the housing building societies is the time when they also receive the
Correct.
rent during the period. Yes, I mean a view is being taken that that should also form part of the sales consideration.
Got it. Okay. Very nice. An assessee sold his flat in 2005, and the apartment got redeveloped. On redevelopment, he got additional area. The redeveloped flat is held for less than 2 years. Please guide on taxability of the such capital gains.
So basically, the assessee transferred the land in.
Purchased, no, he purchased an apartment in 2005. It
Huh.
went through redevelopment and got additional area. And that is being sold for less than 2 years from the redevelopment time.
So whether that be short term or a long term.
Yeah, short term, long term, and yeah, that could be the inference.
So in that case, the period of holding would be, according to me, would be a short term capital gains.
Okay, what happens? His claim is in 2005 it was already been purchased, it was held, and the same asset has been redeveloped. For that reason, will it turn into short term? Is his
The
main
period of holding, the period
period of
hold.
holding happens to be from 2005 from the initial asset, right? That's his
Yes,
note.
yes,
Okay, so it happens to be short term.
yes.
Okay. Okay. In JDA between landowner and builder, what is the TDS rate needs to be deducted by the builder when share of flats related to landlord are sold and amount remitted?
So it all depends upon whether 45(5) is applicable, then the rate is 1%.
Hmm.
Sorry, 45(5) is applicable, the rate is 10%, then 194 IC is applicable. In case 45(5) is not applicable, the rate is 1% of the sale consideration or stamp duty value, whichever is higher.
Okay. Next, tenant property held as capital asset in books of partnership form. Partnership entered into joint venture, come joint development with another LLP. The partnership will receive certain square feet of construction and 50% of the profits from redevelopment.
So basically, what is happening is the partnership has certain
Tenant property,
tenant property.
yeah, as capital asset in books of partnership.
So how come tenant property as a capital asset?
I don't know. That is a question.
What is a tenant
Tenant
property?
property, maybe they have some tenancy rights or something probably from the property. Maybe they have, let's assume as property rather than tenant property.
Exactly.
Yeah, we'll just consider it as a property.
So
There's no,
partnership firm has a property.
yeah. In the books of partnership, they get into joint venture, come joint development with another LLP.
Okay.
Okay, the partnership will receive certain square feet in the constructed area and 50% profit on redevelopment.
Hmm.
What is the tax implications in hands of partnership?
So then,
And
in
time
all
is limited.
probabilities, it would be considered as a business income
It should be
because they're
no.
entering. Yeah, there's a partnership firm entering into other LLP solely for developing of the of the project. So there could be a probability that it would be triggered as a business income.
Okay, business income. And at the time of taxability?
The time of taxability when the time of taxability would be when you receive the sales consideration, maybe.
Only, yeah, maybe that's the main doubt. Here, the time of taxability, whether just getting into the agreement without receiving any consideration in cash, still will it turn into business income is their point of view.
So yes, I mean, if they have not the business income on the accrual concept, we need to see it has accrued to you. You have to offer
Yes.
to tax. Hmm.
Okay. And when two or more people together offer it to a joint development,
Hmm.
whether those two owners together, I mean, there are two owners for a land and they have given it for joint development, will these two owners constitute an AOP for this agreement?
That we need to see the facts and the arrangement about the two owners and with the developer. This is a very fact specific to say,
Yeah, it's
but
very fascinating.
yeah, what are the sharing arrangement? What are the resources? And this is a very fact specific to answer.
Okay. One more, whether stock share agreement between landowner and developer to be treated as joint development agreement or simple development agreement between two people.
Stock share agreement,
Stock share agreement.
joint development agreement, or
No, they are talking about stock share agreement between owner and developer.
Owner and a developer stock share agreement to say
Hmm.
what exactly they are looking at it.
Maybe we require more. Okay, in circumstances of an AOP is being formed between two persons, that is landowner and owner. No, maybe there is little ambiguity in the question. Maybe we have to go next. One more. If a BG is invoked due to a default in this process of land development, what
If
would be the
okay,
BG, bank guarantee is being
bank
invoked?
guarantee.
Yeah, is
Huh,
invoked in process of this some failure or some XYZ reasons of
huh.
this JDA. What would be the taxation?
The taxation of
BG,
the
yeah,
bank. Yeah.
yeah, because
So
the developer may have failed completing or something like that. Something.
so bank guarantee has been invoked. So the taxability of the bank guarantee again would be in the hands of the bank guarantee would be given to whom? The developer, right? Because the developer must have raised the finance on that project.
Correct. No, that's not given. Probably we have to take it from the owner's end also, maybe.
Yeah, yeah.
Yeah, owner has taken a bank guarantee for completion of the project within the time or completion within certain extended time, and that is not happened, and BG is invoked. Then what happens is what their view is.
That
Is the
can be
cost to be
also,
reduced in the consideration?
yeah, yeah. The cost could be reduced from the consideration. That could stance we can take.
Okay. And in case when termination occurs and tax is paid on cash consideration which is already received by the landowner, what happens to the tax paid? They completely terminate the agreement in this case.
So they have terminated the agreement and they have received already the consideration, and
They
that is
receive
I
the
must.
cash consideration, and they have paid because cash in prior they have paid the tax in cash consideration in prior.
Hmm.
Then what happens in this such case?
So that cash consideration may reduce the cost of acquisition of that particular uh, the other asset.
No,
That could be a
their view,
possible
I'll
view.
explain you. I don't know, but I'm assuming that is their view. There came a scenario where the land owner is liable to refund it, and it was a problem from landowner's end. The tax
Hmm.
is paid, but it has been refunded to the developer. Then what happens?
So you're saying as a default on the side of the
Landowner, landowner end.
landowner end, and the taxes have already been paid.
Taxes has been paid. After 2 years, some land acquisition, something like that, has come into a problem.
Huh.
And then what happens is the question.
So probably in that case, we need to again analyze that what it is. It could also be a considered as a capital receipt. We need to see that in a detail.
Uh, will termination of an agreement will make the transfer deferred?
This is a very important aspect, the termination of the fallout of the JDAs. So, if you have seen the all these cases like Balbir Singh Maini, CS Atwal, or there was another the Supreme Court judgment there where they have specifically said about the fallout of the JDAs, where what they say is in that particular cases the JDAs were not registered. Okay. So one view they had taken is the JDA is not registered, the transfer initially had never taken place at all. The second thought process to it was in these cases which comes out is I mean now the JDA has been now the JDA is not there. The condition of 53A has not been of the Transfer Property Act has not been satisfied. So the transfer has not been taken place. So this is the one thing, and not registered also.
Correct.
Also, they have considered that as a hypothetical income which cannot be charged to tax.
Oh, capital receipt, which is not under
Yeah,
capital.
yeah. So they are saying that it's a hypothetical income not chargeable to tax, and therefore it will not be chargeable to the tax. So this is what has been discussed in and in these cases of CS Atwal, Balbir Singh Many, and this is particularly regarding the fallout of the JDAs.
Yeah, the other view would be whether that extra amount received will it affect the cost of the property or
So the extra amount that has been received will reduce the cost of the property or not. In a
yeah,
case, it may be, or it can be taken as a capital receipt as well. We need to see the
scenario.
the facts. Yeah.
Correct. Okay, what if assessee converts capital asset into stock in trade and then provides it for JDA to a builder?
So this is essentially a stock in trade is there. So the
Stock in
capital
trade.
gain was arise when the capital asset has been converted into stock in
Transfer.
trade. So
Yeah,
the 45(2) will trigger, and the capital gains will be chargeable in the year in which
transfer, change
transfer takes
in
place,
stock in trade.
and then going ahead, that will be considered as a business income.
Okay. Also, if landowner does not sell the inventory in future, whether he'll be liable to tax.
He will be liable to tax, yes. When he will be liable to tax, only the chargeability goes ahead in such cases. So he will be liable. He will be chargeable to tax in the year in which the inventory is sold out.
Got it. Got it. In case of
This is the same case, no, where the conversion case and then
conversion of stock in trade to same case, the continuation question of the same case. Yeah. Next question. In case of society entered into redevelopment agreement having no FSA and corpus, and rent is paid directly to the member will, the society liable for tax assessment for the assessment year 15 16. So this is before 17. They might to mention before financial year 17.
So they, in that particular case, 45(5)(a) will not be applicable.
Okay.
This is before, if that is the question they are asking.
Got it. 1 second. Next, sale of house property in 2024 February. What should be the timeline for the assessee to buy the property or construct the house to avoid capital gains?
I think they're asking the time limit of 54.
Ignore it.
Yeah,
It's
yeah.
nothing related to JDA, so it's fine. What case use up the? What will be the case where partnership firm gives land on development? Development, they're not talking about joint development agreement, or is a typo error, I do not know. Okay, if they take land on development, let's say 60/40, and then give the land to sub development to other firms for 70/30, some other ratio, some X ratio, they have taken it on JDA, and they have further given sub development to some other agency. How to find the cost and consideration received if it is taken in the same year?
So again, first aspect would be there are two agreements in this. One is between the partnership firm and the other person, other developer. Developer 1, I would like to name it as,
Correct.
and then developer 1 to developer 2.
Correct.
So from the first, when the partnership to developer 1, again, we have to draw the principles of the judicial precedents. In this case, 45(5)(a) will not be applicable.
Okay. Yeah.
Then that it will be taxed as under the normal provisions of the Act. So the sale consideration cost of acquisition will be determined accordingly. And then the second leg of it, again, we have to determine under the normal provisions of the Act, where I'm believing the two developers, it is just a kind of, it could be a subcontracting also. It could be a contracting or to another developer. So the taxability would be under the normal provisions of the Act.
Okay. Next, another question where the complete consideration, the complete agreement is on revenue sharing basis alone. What would be the sale consideration and year of transfer?
The sale consideration, what would be the share received by the landowner, and the year of transfer. Again, the year of transfer would be the year in which the agreement has been executed. That has been the judicial view. In this case, again, 45(5)(a) will not be applicable.
Got it. Yeah, of course, it should not be. It's, okay, the landowner receives flats. The sale happens before getting the completion certificate. Completion certificate of the apartment was not received. What will be the capital gains? Will it be on flat sale value or land guidance value?
So basically, this is the case of 45(5)(a) as they are referring to completion certificate, I believe. So if that is the case and the transfer happens before receiving the completion certificate, then the normal provisions of the Act would apply, and the 50C can be invoked at the fair market value. The sale consideration can be taken into account as.
Got it. And other thing, what will be the taxability if part consideration received in cash at initiation of the agreement itself? That is what they meant, I guess.
So if the part consideration is received in cash, see, consideration received in cash on land or building, That is immaterial. The first we need to see is when the transfer will take place. In case of 45(5)(a), the transfer will take place at the time the specified agreement has been entered into in the year, and the chargeability will be in the completion certificate is received.
Correct.
Correct. So, I mean, it will, basis cash consideration received. When is the cash consideration received will be chargeable to tax in the year of transfer. What will you consider as a year of transfer? In 45(5), as I told you, another provision of the Act, with the date of agreement, largely that's the position that we have been taken. That will be the year when the sales consideration, even whether you receive in advance, etc., would be taxed in that particular year.
Okay. Next. How to claim TDS deducted under Section 194 IC on the basis of consideration paid in 1 year, whereas the capital gain will be offered in another year basis of completion certificate. They got 94 IC in a previous assessment year, but this assessment year they're getting completion certificate. How to take care of that situation? Maybe it's reverse. Maybe transfer happened before the completion certificate. IC is also done, but completion certificate comes in the next.
So if transfer happens before completion certificate, then IC will not come into place, because then 45 it will come out of the ambit of 45(5)(a). Then 194 IA would apply.
Okay. Okay.
Because if you're saying the transfer is occurring before the receiving the completion certificate, this case is exclusively implicitly excluded from 45(5)(a). Then 194 IC provision will not apply at all.
Okay. Next question. In case of an unregistered joint development agreement, what is the at what point is the capital gains chargeable to tax? Year of JDA, or in which year in which share of land is sold?
So,
Or
so as I in my presentation is also have pointed out few cases like CS Atwal, Balbir Singh, many, where they have said that the unregistered agreement, the transfer will not take place because of the amendment in Section 53A of the Transfer of Property Act and the Registration Act. So rightly said, the capital gains will not be triggered in that particular year. Now the question is when it will be triggered. There are, after Balbir Singh many, the case like this, there are different views that have been taken by the different courts. The view, as I said earlier also, in case of the fallout of the cases, obviously unregistered agreement, capital gains would not arise. In case of the normally fully executed JDA, they say that all the 53A conditions are satisfied to say that both the parties have agreed all the performance have been completed. So the capital gains would arise in the case of the date of agreement itself or the completion unit. So there's two different views that have been taken by the different courts. One very interesting case law which I would like to refer, since we are discussing about the unregistered agreement, is about the Tamil Nadu bricks of the Chennai IT-80 case. Interestingly, what they have done is they said that when the agreement is unregistered agreement, but the general power of attorney was registered, in that you have transferred the rights to the developer to enter, construct the land, and take the necessary approvals. So this is as good as that the immovable property has been transferred to an unregistered document, and therefore the transfer has taken place as per Section 2, subsection 47.
Okay.
So there are different views applicable, but in certain cases, the registered GPA is also considered as as a transfer. The recent case of the Chennai IT-80.
So it depends on.
It depends upon, again, there's no straitjacket formula still. If your case falls under 45(5)(a), yes, I mean they also have the interpretation issues. Again, there is no straitjacket formula, and it all depends on the facts and circumstances of the case.
Okay, in the next event or not, I'm just asking whether RERA will be applicable to the landowner, because it was asked.
So I do not have the requisite knowledge about whether RERA will be applicable to landowner or not. But yes, as far as I know or I recall some of the provisions vaguely on the RERA, they say that for, sometimes you have to show the landowner as a developer or a promoter to obtain the insurance, or or making the applications. That is the situation I had taken, that there are certain times when the landowner is shown as a developer. In that case, whether 45(5)(a) would be applicable. So if the landowner is shown as a developer for the incidental purposes, then you have to see the exact roles and the responsibilities, and the landowner is not involved in developing of the project, then 45 then still 45(5)(a) would be applicable.
Okay.
If that is the question about RERA applicable to landowner and thus is shown as a promoter, and whether 45(5)(a) applicable, so this is what in that context.
Got it. Next, can you throw some light on how cost of acquisition will be apportioned for the landowner's view?
Cost of acquisition will be apportioned as in what cost of
Like
acquisition?
example, he provides some land, he gets the total 100 apartments, he gets a share of 40 apartments. And the cost of land in some X year is 1 lakh. How will it be apportioned
So
for 40 apartments?
so basically that will be on the percentage basis, how much land he has been transferring to the developer.
Let's assume 10,000 square feet transferred 6,000 square feet to the
So
developer.
6,000 square feet has been transferred. The cost of acquisition of 6,000 square feet on the proportionate basis will be taken as the cost of acquisition.
Okay. Oh, and that gives some light on it. Whether redevelopment agreement be considered as JDA?
Yes, redevelopment in case of the housing societies, typically they go on the redevelopment. That is a joint development agreement only.
Okay. In joint development agreement, there is a security deposit to be paid to the landowner by the developer, and landowner will get area share and revenue share. Will TDS be applicable on such JDAs? On what amount?
So it all depends upon 45(5)(a) or not 45(5)(a) case.
Let's assume
I'm
40.
assuming,
Let's assume 45(5)(a).
if it is 45(5)(a) case, then 194 IC will be applicable, and 194 IC says 10% of the amount of the total consideration. And the consideration would be what? The stamp duty value on the receipt of the completion certificate,
Okay.
plus the additional cash consideration which has been received.
Now, an apartment got developed 20 years ago with 10 units of apartments. In 2024, it is redeveloped to 14 units of apartments and 4 apartments given to the builder. And the 10 owners retain all their respective 10 flats, whether they need to, the owners have to pay capital gains in their proportion.
So you're saying 10 units, and the 10 units were given to them?
No. There are 10 units which is an old apartment with 10 units with 10 different owners. The same got redeveloped to 14 units, and 4 units were taken away by the builder. 10 units, each owner gets one unit back. Whether capital gain applicability is there in this scenario?
Yes, that would be applicable, because there are consideration that has been received by the developer for giving up this development right. So yes, the capital gains will be applicable.
Okay, what if a JDA is made in 2013 and still project not completed till date? 45(5)(a) is applicable or no?
So that is seen from the date of execution of the JDA.
So 2023 is the execution.
So 2023 is the execution date of the JDA.
Correct.
So you're saying 2013?
2013, 1-3. Yeah, before 2017. Yeah.
Yeah, before 2017, then 45(5)(a) will not be applicable.
Correct. That's the answer directly. If the landowner is a private limited company, how and what section applies?
Private limited company, 45(5)(a) will not be applicable.
Will not be
Normal
applicable.
provisions of the Act will be applicable.
Normal provisions. So taxable asset is flat or land after completion certificate?
Taxable flat is? Sorry?
Taxable asset is a flat which is completed or the land portion after completion certificate is received.
So both are there will be the capital asset, no taxable asset. If you are meaning to say the capital asset,
correct. Taxable
yeah.
asset.
So so both will be the capital asset only. I mean, if that is the question.
Okay. The question seems to be little incomplete, so we can go forward. We'll take one or two more questions and maybe madam. If completion certificate is received, but few flats are unsold, even then the tax has to be paid on all the flats.
Sorry, can you repeat that?
They have received a completion certificate for the complete project, but few flats are unsold. Whether tax has to be paid on all the flats.
Yeah, the transfer has already been triggered in the initial year, no, when the specified agreement has entered into. Only the the chargeability is extended to the year in which the completion certificate is received. So as soon as you receive the completion certificate, you have to pay the capital gain tax. That is not dependent on how much is sold and unsold.
Got it. Then we'll go to the next one. JDA is entered with one assessee, and the same assessee is dead after the JDA is entered with. After that, a person enters into JDA as a owner. He is no more after some time. Then there's an additional JDA done with the legal heirs. Both are registered. Then what would be the date of effectiveness of JDA?
I mean, this is more of a legal question to sing, but as far as my knowledge is concerned, I think the first date would be considered as the date of the effective JDA, because the question says that they have there's an addendum to the agreement in the capacity of the legal heir. So given that, looks like that the first agreement would be the effective date. However, this is a very legal question, so I mean, the legal fraternity would be the right people to answer this.
So thank you very much. It was such a wonderful session. Of course, the completion will be done by CA Piyush sir. Over to him.
Actually, I was not supposed. Thank you very much. Very good afternoon to all. Richa, I would tell you I was not supposed to join again. And my colleague, my vice chairman, Kota Srinivas, was also supposed to join, but he's also stepped up. And then I got a message from the office that there is a huge response. For your information, there is more than 3,500 participants who are watching this. It is an enormous success, I can tell you, Richa. Nishal, very well, you have covered all the questions. I know there would be many questions coming up as we had envisaged when we started and we chose this topic. And I'm sure, obviously, she has answered the best of her ability. But I'm sure if you are sharing your numbers and your contacts, a lot of calls will be coming to you, because JDS still remains a lot of litigations which you yourself have mentioned, that it will depend upon each facts of the case, and each individual facts are different very well. Each JDA is different. There are a lot of enormous litigation issues which are going on. I mean, I come from Mumbai, city of Mumbai. The JDAs, all such agreements are as of today only JDAs. That's how the construction is happening majorly in the metro cities. So I'm sure, but thank you very much for being here, Richa, and the way you have delivered your lecture, it was enormous. It was superb, I can tell you. There's a very good response which has come, and please do keep it up. And we look forward to for your support to the DTC in the future also. Nishal, thank you very much for dealing with all the questions. I know on the chat there would be many questions which would have been difficult for you also to rearrange them, select which one, select which not, because when you are talking of JDA, there would be also questions coming on exemptions 54, 54F, whether the capital asset is a residential. I was just listening to certain questions 15, 20 minutes. So people are also wondering that if they are selling before AC, so OC. So whether it is a of course it is a capital asset, but whether it's a flat or it is not a flat, because it affects their calculation of 54, 54F, all those things. So thank you very much once again for joining it. And to all the participants, thank you very much for being attentive and joining in the large numbers. Every week we'll be coming up. Next Thursday again we'll see you at the 4 o'clock, unless there is a change which happens, but from 4 to 6 is generally our time for the webinar. Please keep watching for the programs which are coming, the webinars which are coming. And please believe me that Direct Tax Committee of ICI always try to select the speakers from across the India. So this time the team is from Bangalore. Last time you would have felt that it's coming from Mumbai. Somebody is delivering from Delhi. So this is the webinar where you can get a flavor of these speakers who would otherwise be very difficult to reach your hometown where you are situated and address physically. But at least by through this webinars, we are getting a benefit whereby we can also get the speakers across the country, and that's the benefit of this webinars. Please look forward to this sites and keep attending it. Thank you very much. Nishchal, you would like to propose formal vote of thanks to the speaker?
So I'll just brush up through the event today. We started with tips from Piyush sir, and we started with talking about real estate, which will hit $1 trillion by 2030. Single FDI company coming and putting around $50 billion into Indian real estate. Understanding the benefits and the process of JDA and its taxation, knowing about judicial judgments, and ending with a huge set of question and answers and a lot of effort. And Richa Bakiwala ma'am has done a tremendous job of addressing all the questions and also overwhelmingly explaining most of the situations which will be covering under JDA. A lot of effort to be put through come to this stage, and definitely have to thank the complete DTC team for giving me this opportunity to moderate this session, and a lot of backend team, tech support team who are involved in this. If one session has to go successful this way, then there are hundreds of people behind it to make it success. Thank you one and all for attending this session and making it 3,500 plus views at the moment. Thank you very much.
Thank you. Thank you, everyone.
Tech team, you can stop the recording.